As an asymmetric investor, I'm always looking for great companies with phenomenal upside to buy and hold long term. Really, that's the goal, is just to buy a stock and hold it for the next 10 or 20 years. And one company that is absolutely a phenomenal business is Adobe, but the stock is not one that I'm buying today. And in fact, I would consider selling if I did hold it. And the reason for that is the price is just incredibly high. I'm going to give you some numbers. Adobe's price to earnings multiple is 52. The enterprise value to sales multiple, which is basically the value of the business just divided by the sales in the last year, is 14.2. Once you start to get over 10 times sales, that is a very, very high multiple to pay for a company. And this is a company that is at scale. Everybody knows who Adobe is. Every artist is using Adobe. So we're not talking about a startup with 20, 30, 40% growth rates. This is a company that's expected to grow 11% over the next 2 years, according to analyst estimates. And yet the stock is insanely expensive. So today I want to get into what we have seen from Adobe, why the stock has done as well as it has. Shares are up 73% over the past year, and why this is not a stock that I'm buying today. Two things can be true. This can be a phenomenal company and it can be a terrible stock. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsored, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. Let's take a look quickly at Adobe's business overall. And this is just a chart of revenue and net income over the past 10 years. And you can see that revenue has exploded from $14.1 billion in 2014 all the way to $19.4 billion. The 10-year compound annual growth rate is 17%. So that's a really, really good growth rate, especially for a company of this size. On the bottom line, you can see that Adobe was barely profitable 10 years ago. $268 million in net income in 2014, up to $5.4 billion last year. But look at that net income number since 2020. You can see that net income is effectively flat between 2020 and 2023. So while revenue is growing, earnings are not. So that's something to keep in mind, is that the stock has done insanely well over this period of time. But if you just look over the last 3 years, there's starting to be a little bit of margin pressure. So why has the stock done as well as it has over the past year alone? And I think the reason really comes down to artificial intelligence. AI really became the hot topic late in 2022, and investors were trying to figure out where can you play AI in the market. And Adobe became a natural answer because of products like Firefly. That was Adobe's answer to things like Midjourney and DALL-E, where you could do image creation in artificial intelligence. The problem with those two is that there's at least questions about the intellectual property rights that you have with those models. So if you're an advertising agency, for example, or you're a major company, are you going to want to use an artificial intelligence tool that may not be creating assets that are legal for you to use? And so Adobe's answer to that was to say, hey, we're going to build our own models and we're going to train it based on assets that we own, on pictures that we own. And that's what they have done with their products. And they've started integrating this across all of Adobe's products. So we're going to be seeing more and more images, much, much easier to edit images today than it was a year ago using some of these artificial intelligence tools. So that's a great feature for Adobe to add. We're going to see it more in video editing. So there's absolutely going to be some tailwinds behind Adobe. But let's not forget that there's also more threats to the business than there has ever been before. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. We learned in just the last few weeks that Adobe is not going to be able to acquire Figma, a company that it tried to acquire for $20 billion, because it was trying to get into these creative tools that people are using to use in cross-functional teams. Figma is used to create a lot of it. Figma is used in a variety of different ways. But one thing that's really used for is to create things like websites and apps where designers and programmers can work together in the same canvas, even at the same time, to change layouts and see how these things are going to work together. So instead of going into something like Illustrator or Photoshop and just creating an asset and sending that asset to somebody else, you're actually working in the same environment. Same thing goes for a product like Canva. Canva is what I use to create things like images for my YouTube channel. And it's much easier to use, and and you can use it at the same time on the website with other people in your team. So Same thing, maybe not quite at the high end experience that you get with a lot of Adobe's tools, not nearly as high functionality and artificial intelligence. But if your goal is to just create an image that you're able to use on YouTube or in a presentation or create a short video, Canva can be both a cost effective and much easier to use tool. So these are competitive threats to Adobe's ecosystem. Disruption in a business like this doesn't come from the top down. We're not going to see a competitor create a product that does Photoshop better than Photoshop. We're going to see a competitor create a product that's easier to use and cheaper and attracts a bunch of users and then improves their functionality over time, eventually eating into Adobe's business. That's at least a little bit of what we're seeing on the net income side and the pricing side. Now, Adobe has been able to continue to grow their business. And like I said earlier, analysts are still expecting double-digit growth over the next few years. But when you think about competition from companies like Canva and Figma and the fact that Adobe is probably not going to be able to acquire them, already tried to with Figma, I think the competitive environment is getting worse and the valuation is incredibly high for Adobe. So what investors are going to want to watch over the next couple of years is a couple of things. Does Adobe's revenue growth rate start to slow down as some of these competitors peel away some of their customers? Adobe can always raise prices, but when you raise prices, you make some of these competitive products a little bit more attractive. And we could see Figma start to integrate some of these tools into their platform. So now instead of living in Adobe as the center of your creative universe, you're living in Figma as the center of your creative universe. Adobe's maybe a tool, but it's not the same place in the ecosystem as it used to be. I think that's ultimately the big threat. So where we would see that is in both revenue growth and then also net income on the bottom line with pricing and margins. Let me just go through a little bit of what analysts are expecting for the next couple of years, because again, I think the expectations are relatively low given the price of the stock. Revenue growth rate over the next 2 years expected to be 11.4%. EBITDA growth rate, 11%. Earnings per share growth rate, 12.6%. Those are relatively modest growth rates given the growth that Adobe has shown over the last decade. But again, the threat for the company is going to be if they miss any of those marks, it's going to call into question, hey, are they actually going to be even growing even slower than that? And that's where you will see the stock get hit. I think it's great that Adobe is answering some of these artificial intelligence tools. I think it's great that Adobe is answering some of these artificial intelligence questions for its customers. But a lot of those customers are at the high end of the market. And what I would worry about is the low end of the market is going with other competitors. Talked about a couple of those, and there's all kinds of image creation tools, whether that's through apps or websites, new models. And it doesn't appear right now that those are going to be any sort of copyright challenge. So Adobe may be answering a question with products like Firefly that the market isn't all that concerned about. They're just concerned about, can I make an image that I want to make at a relatively cost-effective price point and do it simply? I don't know that Adobe is the best place to do that for a lot of creators in the market. And there's simply more tools today than there has ever been, whether you're looking at image creation and editing, video creation and editing. So that's the ultimate threat for Adobe, is this is not the kind of growth company that investors are pricing in. I don't want to focus on price as an investor most of the time, but price does matter. And paying a double-digit enterprise value to sales multiple for a company that is starting to see revenue growth slow and net income stagnate, I think is a really dangerous position for investors. So I would be selling the stock today, not a stock that I own, but I want to put that warning out there for investors that some of these companies that have done really well on the back of hype from artificial intelligence may have a rough couple of years ahead as they try to live up to that hype. So what do you think about Adobe? Do you agree or disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.